ratio analysis remains one of the most widely used tools for interpreting financial performance and position. It condenses large volumes of data into key indicators: profitability, liquidity, solvency, and efficiency. However, its usefulness depends on the quality, comparability, and consistency of underlying data. One limitation is that ratios are based on historical information, providing a backward-looking view that may not predict future performance. Economic conditions, inflation, and technological disruption can render past ratios irrelevant. Moreover, ratios are static snapshots, ignoring dynamic interactions between metrics or changing business conditions. Without forward-looking analysis, ratio interpretation risks misleading decision-makers about sustainable performance. Another major limitation is the lack of uniform accounting policies across entities and industries. Even under IFRS, choices such as depreciation methods, inventory valuation, and revenue recognition policies can materially alter ratios. For example, two companies with identical economic performance might report different profit margins due to varying depreciation schedules. This weakens cross-company comparability, particularly in international analysis. Analysts must adjust ratios for accounting differences or use standardized metrics to achieve meaningful comparison. Furthermore, reclassifications or changes in standards, e.g., the introduction of IFRS 16 leases, can distort trend analysis by shifting liabilities from off-balance sheet to on-balance sheet presentation. Ratios are also subject to distortion from extraordinary or one-off events. Exceptional gains, asset impairments, or restructuring costs can inflate or deflate profitability and efficiency ratios without reflecting core performance. Analysts should normalize data to remove such anomalies. Additionally, ratio analysis assumes stable relationships between financial variables, which may not hold in volatile environments. Rapid inflation, currency fluctuations, or supply chain disruptions can alter asset values and cash flow timing, undermining ratio stability. Hence, ratios should be interpreted as indicative trends rather than absolute truths. Another limitation is that ratio analysis focuses primarily on quantitative data, neglecting qualitative factors such as brand strength, innovation capability, or employee engagement. These intangible drivers of value creation often determine long-term success but are not captured in financial ratios. Integrated reporting under the IIRC-IR framework addresses this gap by incorporating non-financial capitals, human, intellectual, and social, into performance evaluation. However, analysts relying solely on traditional ratios may overlook these dimensions, leading to incomplete or biased assessments of organizational health. Comparability issues also extend across industries and time periods. Different sectors have unique capital structures, asset turnovers, and risk profiles. Comparing a software company's return on assets with a manufacturing firm's provides little insight due to fundamentally different business models. Similarly, changes in macroeconomic conditions or accounting standards can make year-on-year comparisons unreliable. Analysts must benchmark ratios within relevant industry contexts and supplement them with trend and sensitivity analysis. Ratios should be seen as interpretive tools rather than definitive indicators of performance. Ultimately, the value of ratio analysis lies in its interpretation, not its calculation. Without contextual understanding of the business model, strategy, and external environment, ratios may produce misleading conclusions. To overcome these limitations, analysts should integrate ratio analysis with predictive and prescriptive analytics, using models that link financial outcomes to strategic decisions. Triangulating ratios with non-financial data, market intelligence, and forward-looking metrics enhances insight quality. By acknowledging ratio limitations and complementing them with broader analytical tools, finance professionals can provide more accurate, relevant, and future-focused recommendations that truly reflect organizational performance and potential.